To begin by commending the Center for Global Policy Solutions on organizing this summit. I think it's a summit that's very much needed. And also thank you, Avis, and thank you, Maya, for inviting me to participate. If we go to the next slide, please. I'd like to start with what I think we might be able to agree on, because I have a feeling there may be some disagreements on some things. The homeownership rate differences among minorities and whites are worthy of national discussion, but so are potential solutions. According to the Census Bureau, homeownership rates, these were pre the announcement a day or two ago, for non-Hispanic blacks, Hispanics and non-Hispanic whites were 43%, 45%, and 73% respectively. Credit is a key input into the ultimate sustainability of any loan and the stability of both neighborhood and national housing markets. The credit profile of these groups is vastly different. In 2007, and this would have predated the collapse of the housing market, a Federal Reserve report that Congress requested of the Fed on credit scoring found that the median score for blacks, Hispanics, and whites was 618, 670, and 737. These are the roughly familiar FICO scores that most people are familiar with, and these were interpolated from the Fed data. The same report found that credit scores were predictive of credit risk for the population as a whole and for all major demographic groups, and further, credit characteristics included in credit history scoring models did not serve as substitutes or proxies for race, ethnicity, or sex. Jim alluded to this. Blacks and Hispanics are expected to account for, the numbers I saw, well over half of new household formations 2010 to 2025. Next slide, please. I think the contentious issue is phrases like duty to serve, disparate impact, the phrase that expand the credit box. Those, I think, are the contentious issues. There's one view that narrow underwriting prevents low-income and minority borrowers from getting loans to the same extent as higher-income non-minority ones. This was the argument that was used in 1992 to justify the affordable housing goals, and I do believe that the loosening of underwriting, which was the result of government policy, had a huge impact and was instrumental in the financial crisis, the housing crisis, and the ensuing financial crisis. But there's another view, which is that the qualified mortgage credit box is broad, deep, and pro-cyclical today. And during a boom, the lending will expand further and further into the bottom of that credit box. All Fannie Mae, all FHA, and all Freddie Mac loans today are pretty much eligible for this very broad, deep credit box. On the slide, there's some examples of very low-risk loans and very high-risk loans. I would point out that below the very high-risk loans are two more layers of FHA loans that they haven't been making very many of, but that is now starting to change. Announcements that have been made just recently, lenders that are reducing the overlays at the behest of FHA, and so FHA will be moving further and further down the credit box, which will just put low-income and minority families back into the same problems that they've faced for many decades. This high-risk lending will, again, have a disparate impact on low-income and minority families and neighborhoods. Just as a thought experiment, in terms of thinking about the challenges that this conference is trying to address, if you were to raise black and Hispanic homeownership rates to the white rate of 73.4%, that would require an origination of 10 million new homes. You'd have 10 million new homeowners, totaling about 1.7 trillion. That's the average FHA loan, so I use that. With an average score of about 630, that was interpolated from the Fed numbers that I mentioned earlier. I would assume that they'd have a down payment that looks like an FHA loan, 3.5%, give or take. Median debt to income that looks like an FHA loan, around 42% pre-tax. These loans would present high risks to those home buyers, those neighborhoods, the lenders, mortgage insurers, FHA, taxpayers, Fannie, Freddie, whoever is doing them, they'd all be faced with extremely high risk. Those loans would have a default rate under stress of roughly 35 to 30%, 1 in 3, under stress. Stress is what we just experienced. Those defaults would not be evenly distributed. There would be greater concentrations in low-income and minority neighborhoods. Next slide, please. A second thought experiment. A home loan with a 630 FICO, the same one I just described, 4% down, 42% debt to income. FHA has a lot of advantages it brings to the party in terms of reducing the cost. It has cross-subsidies that it brings, and that allows for substantial underpricing of high-risk loans as compared to the private sector. If the private sector were to offer a 30-year fixed-rate, fully assumable loan and have it adequately capitalized for the risks that this very risky loan would present to that private investor and private originator, they'd have to have an interest rate on that loan that's somewhere in the 10 to 12% range. Again, this is a 30-year fixed-rate loan. And that loan would have a payment constant, the amount that you'd have to pay for every $100 borrowed, of $12.34. That's the payment constant. It would still be a very high-risk loan. Again, it would have a default rate of somewhere about a third. The amortized loan-to-value, including the down payment, at the end of year 5 would be 94%, so there would be 6% equity, not even enough to cover the buy-sell cost of selling the property at the end of the 5 years. If you take the FHA loan at 4.25%, same 30-year, same fixed-rate loan, it has the FHA fees, you'd have a loan constant of 7.25 or $7.25 per $100. Clearly still a very high-risk loan. In fact, the risk doesn't change. Even though the interest rate is lower, it doesn't change because that savings in constant has been capitalized into a more expensive home. And so the buyer still has the 42% debt ratio, still has only 4% down, and still has the 630 FICO. At the end of 5 years, you have a little bit more amortization because it's a lower interest loan that has a little faster amortization in the early years, but you still have around 10%, which again is just about enough to cover the cost of selling the house at the end of 5 years. There is an alternative as a thought experiment. If FHA homebuyer were purchasing only a 32% more expensive house instead of a 67% more expensive house, that the savings that FHA brings to the process, then you'd have an interest rate of 3.25% because it would be a shorter loan. Mortgage insurance premium would be much lower. The constant would be higher, but now it would be $9.15. And you'd end up buying a home that was 32% more than the private example, but less than the current FHA example. This would dramatically reduce the risk to borrowers and to neighborhoods. The amortized wealth at the end of 5 years is 30% or an LTV of 70%. So now you have a borrower at the end of 5 years that has many options that the other borrowers don't have. They can, if they come on trouble, they can sell the house and probably have a profit. If they come on trouble, they can go to the lender and get a modification that extends what is now an 11-year loan to 15-year loans and reduce the monthly payment. They can decide that their family's grown and buy a larger house with the down payment that they can get out of selling the first house. Or they can stay in that house and continue building equity. So 3 times the wealth building effect, $10,500 on the first example with FHA versus $31,000 on the example I gave. In my mind, that's the way, as a thought experiment and a way to approach really building wealth for communities, low income and communities of color. Thank you.
Thank you, Edward.